To a quick video on how to place an options trade. Just a quick disclaimer that if you don't know what options are, or you want to learn more about options, you can go to my other video that I posted previously on my channel, and it'll explain what an option actually is and how to make money and the actual strategy behind it. So let's just do a really quick one on how to actually place options. I'm going to be using an options trade on WebBroker, okay? And you can use this for any platform. They're all pretty much similar. So you're going to log into WebBroker just like anything else. Pretend you're doing an equity trade. I'm assuming you've done an equity trade and not skipping straight to options, because I've never met anyone just skipping straight to options. So you're going to click buy/sell at the top right corner of the screen. I've circled that in red. It's very straightforward, and the brokerage will have signs to walk you through. So I'll show you guys that right now. Once you've clicked on buy/sell, this is where you're going to get up. Usually it pre-populates for you. The default is stocks and ETFs over there on the left-hand side, but you're going to switch over to options. Okay, so you are literally just going to fill out whatever it asks you. Make sure not to miss anything, and I'll go over some things that people usually miss at the end. So the symbol or the name, you're going to fill that in. Make sure you choose the right Canadian or US option. Expiry, strike, whether it's a call or put, make sure to remember to do that. The action, buy or sell. The quantity, of course, it's not like stocks where you put in 100 shares, 200 shares, 300, you can go up to thousands of shares. One option contract is equal to 100 shares of the underlying security 99% of the time, so make sure you're doing 1, 2, 3, or those multiples. Price type is going to be up to you. Normally with options, you do want to set a limit unless it's a very, very highly traded options, because it's not like stocks where the spread between the bid and the ask is very small. This is a larger spread, okay? And the good till, usually you leave it on day. So here we go. I've put everything in here. So we're using TD just because it is TD WebBroker. I'm not, suggesting anything like that. And please consult your financial advisor about that. So TD, this is only going to be on the Canadian market. Quick disclaimer: if you are looking to trade options and very heavily and want a better market for it, the U.S. market is a lot larger than the Canadian market. If you're looking to trade these interlisted security, make sure you keep that in mind and look at both sides to see if you like one more. Expiry date, strike price. So the strike price is going to coincide with the actual underlying price. Whether it's a call or a put, action on this side, we're going to buy to open. The quantity, remember, it is one contract is equal to 100 shares. So one would be betting on the price movement of 100 shares. And the way that you calculate that is you're going to do 100 times the premium that you're going to be paying for your call option, okay? Price type, for simplicity's sake, I left on the market. Please be careful with this. I would suggest to do a limit just in case, so you can actually set your price, at least a limit. If you know the other order types, you can visit my other video on it if you want to get more fancy with it, or if you want to set ranges. Good till, you're usually going to leave on day, okay? Set a good till cancel date if you want, or participate in the extended trading hours. But if this is your first time doing it, just leave it on day for now. You're going to submit the trade, review everything, make sure you have enough money in there. It's going to tell you how much you actually need to pay. The cool thing about our options is that you are going to be potentially making more with a lot less, okay? So here in this case, we have the price there, and you will notice that the commission will be a lot higher than your equity trades. So your options trade is going to be the price plus the amount of contracts that you have. Okay, so on the amount of contracts they have, I don't know, an extra $1, an extra 50 cents, an extra $2, depending on the brokerage and depending on how heavily you trade. All right. So that's it. You've placed your first options trade. Good job. Great. Welcome to the game. So these are the top 5 common errors that I've seen. Check that the underlying stock is correct. Okay. So there was, a crazy scandal at the beginning of the pandemic that people were trading Zoom, for example, and they were typing in Zoom, the ticker, when really the ticker is ZM. Okay. So make sure that, you are putting in the correct ticker for your stock. If you don't know your ticker, just write it out. It'll give you a suggested list and you can pick from there. Check that it is on the Canadian market or the US market or the correct market if you're trading overseas. I'm just going to be assuming most of my viewers are going to be Canadian and US market traders. Check on the expiry date and the strike price. Okay, so it's not like stocks where you can just buy and sell at a price. You do have to check the strike and the expiry date, and also make sure you've selected the correct position. It's not just selling something and buying something. You can buy to open something. You can naked buy something when you don't have the underlying option, right? So right now, if you wanna get yourself, you want to make sure that you have the correct position and the correct if it's a call or a put, right? So lastly, I'm going to give you guys just an example of being covered. So if you're performing a covered call, which is a very common thing that people like to do to get extra money on the shares that they already own. Covered call is selling calls with the stock already owned, because if you sell stock and you lose the bet, so to say, you owe that person your shares at the price that they chose with the strike price. Okay, so a lot of people like to do a covered call where they actually already own the shares and they've already entered into a profit so that they can just collect the premium. And if they happen to lose the shares, they happen to lose the shares because you're going to be paid for them anyway. So it's generally a lot more risky to do this naked, which means that you don't actually owe the shares. So if you get assigned and you owe the person the shares, you have to go to the market, pay for them, and then sell it back to them. Okay, so that could be really bad if, let's say, the strike was for $50 and it's currently trading at 60. You're gonna have to go to the market to buy 100 shares at 60 and sell it for 50, and you're at a complete loss. Okay, so that's it for today, guys. Please let me know what you'd like to see more of. Check out the other videos, especially the how to short, and related to this video, the how options actually work and the different types of order types. Okay, make sure to like, comment, and subscribe. I did also leave a link at the bottom. Join our Discord server. We're building a great community of people who have tons of great questions and tons of great answers, and we're all just looking to make some money through investing. All right, so see you everyone, and have a great day.